starting to see any sort of distress? People who over-levered, builders who extended themselves, buyers who extended themselves. Is there any of that happening yet, or is it all too early?
It's a little too early in the real estate market because to the extent that you're seeing transactions that are occurring today, that was baked in 3 months ago. So the volatility that occurred in, say, August and September is less relevant for seeing where clearing prices are. What we are going to see, and what we do see now, if you speak to any of the big brokers, or even the scuttlebutt that's occurring all around, is that it's crickets out there. Just nobody's trading unless they have to.
I like the expression crickets out there. Okay. That's not the cricket we play in Australia.
Exactly. And I would say that to the extent that you're seeing deals, it's less about distress and more about pressure. That's what's happening now.
This is the Definitely Uncertain podcast, brought to you by Goldrock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice. This is the Definitely Uncertain podcast, and my name is Darren Rockman, and I am a partner at Goldrock Capital, the 22-year-old multifamily office servicing high net worth families in Israel and around the world. And we are now in turbulent times with markets all over the place having a rough ride as interest rates go up and markets react to that. But one area where perhaps we've seen less action so far has actually been in the real estate market, and particularly residential real estate in the United States. So to talk about that, the equity, the debt, and maybe what the coming quarters looks like, I asked Saul Lubetski, my very old friend, to join the podcast. Hi, Saul.
Hi, Darren. Thank you for having me on the podcast.
It's a really great pleasure. So Saul comes to us from New York. He is vice chairman of Harbor Group International, a pillar of strength in the U.S. Real estate market, and great partners. Saul's been with him for many years. Prior to that, he was a lawyer at Skadden Arps. He headed up vice president of global real estate at Sullivan Smith Barney Investment Banking. He has a BA from Yeshiva University. He has an LLM from New York University, and he's one of the smartest real estate investors that you'll ever come across. And you can watch.
I'm not sure about that. Everything else I agree with because that was facts. I'm not sure that's true.
That's a little Darren commentary there. Yeah. Multifamily real estate's really had an incredible run over the last decade plus. Since the 2008 crisis, it's really been a one-way ride, even through COVID, which was really just a blip. We saw rates go down, we saw cap rates go down as values went up. Now that we see interest rates going the other way, interest rates are rising, what do you see in terms of the outlook for residential property prices?
It's a big question, and there's a lot of ways you can answer the question. So let me start with just a broad statement. Interest rates in and of themselves are not a real estate cycle killer. We don't view that as a cycle killer. We think that, broadly speaking, all things being equal, the biggest thing that kills a real estate cycle, especially in multifamily, is oversupply. And again, in the United States, today for sure, demand outstrips supply. What that will look like 3, 5, 7 years from now, I'm not sure, but today demand far outstrips supplies. Interest rates and their movement affect the finance and the spread and the income that you can make on real estate. And there's no question that the rise in interest rate, and really, we're not talking about a rise in interest rate so much as we're talking about a spike. And to put some numbers around that and to show the dramatic move, at the beginning of the year, say January and February, the 10-year, which is the financing rate, was around, call it 150 to 185. It touched over 4, which was a shock last week. And now it's somewhere in the 360, 370. Today it's trading closer to 370. That's a huge move in a 6 to 8 month period. And of course, it's driven by geopolitical concerns, inflation concerns, and otherwise. But what it's done more than anything is not show us what the value of multifamily real estate is. It's just put a chilling effect on transactions. So transactions have just dropped off a cliff.
Okay, so let's just rewind back. 2008, there was a massive oversupply of housing, and as soon as financing was no longer available, that then pushed prices down drastically. What you're saying is that this time it's different, famous last words, but this time it's different, and there isn't that oversupply, but that the spike in interest rates is going to create a problem in the finance market. But what you're also saying is that we're not seeing much in terms of transactions, and that means we're not yet seeing, which is normal in this sort of stage of the cycle. We've seen it before, which means we're not really seeing the true reflection of values given the move that you mentioned.
Correct. Just to give you a good example, when we're bidding on multifamily today, we're bidding somewhere at, call it 15 to 20% discount to, I don't want to say the highest price, but the clearing price prior to the movement in prices. And the actual, where we're seeing things clear is somewhere in, call it 7 to 12% range. So we're way off on our pricing, at least where people would clear the trade.
Right. So if you take the peak of the market, we're now 7. But by the way, when we had a conversation, I think it was June or July time, I remember you were talking about sort of it was a 5% discount, and now 7 to 12%. So we're seeing slowly the market absorb a sort of new pricing mentality.
That's correct.
Okay.
Now remember, there's at the moment, the reason why we're not seeing a lot of clearing transactions is because even people who bought floating rate, let's say in the beginning of 2001, I don't want to say 90% of the cases, but let's say 75 to 80% of the cases, they bought caps. And actually, they've either hit or are hitting their caps now. So they're not coming out of pocket now. They're not coming out of pocket. It's the people who bought maybe in 2000.
The market.
Exactly.
Right. So those that already own real estate either bought taking fixed rate loans or floating rate loans, but they don't go too high. So they're not really feeling their cash flows dry up. But if you wanted to go and buy something new now, you're going to have to go into the mortgage market. You're probably not going to get a fixed rate loan. You're going to have to get a floating rate loan because nobody knows where interest rates are going to go. And that just makes it a lot more difficult to buy.
So I'll give you an example. If we did a deal in March, now the deal, when you do a deal in March, that means that you are
negotiating in November, December,
in February, and January, right? Sure. So we got a 5-year fixed rate deal from a large debt fund. It would be a recognizable name to anybody that's in the finance market, and that was at 3.25. That same loan today, given our activity in the debt markets, would price somewhere at 5.75.
If you could get it at all.
If you could get it at all, exactly.
Okay, so now talk about what that means. Okay, so given that very large move, is a 7 to 10% reduction in values, is that really reflective of the spike that you're talking about?
So you've heard me say this a lot, and it's really something that I feel strongly. To make a statement about real estate is really irrelevant. There is no monolithic answer about real estate. You have to go market by market. So to the extent that you're in high growth markets, high volume markets, then the discount is maybe not 5 to 7 or 7 to 10, it's probably 10 to 15.
Okay.
Why? Because rental rates have gone up by 20 to 30%, particularly in some markets. So think of Miami, the huge outward migration, but it was not just about the migration. It's not just a demand factor. It's the type of people who move there. So if you buy Class A in Miami, there are people, let's say, most notably, let's say Citadel announced that they're moving their headquarters into Miami, to the Brickell area. And they're going to spend billions of dollars building 2 new office buildings, and there's going to be an influx of highly paid people.
Right.
So that's changing the dynamic of what it means for the rents in Miami. If the rents were 2,000, 5,000, 10,000, now they're going to be 20,000.
Right. And that's also been reflective in house prices in Miami because you've seen 2021, doubling of values in a lot of places.
Right. There are other markets, of course, where pricing has not been stagnant, but the rise has been slower than either the rate of inflation or the move in interest rates, and therefore debt service coverage have much more pressure. So again, going market by market, you're going to see a very big gap as buyers and sellers adjust to the new reality, or the new normal.
Right.
In 2021, you could barely tell the difference between a C-class property and an A-class property. Today, for sure, there's a flight to quality. and there's a widening gap between the A's and the B's.
Okay. Now, at the same time as we've seen interest rates going up, we've also seen commodity prices going up. And that maybe has come off from the peak, but still, if we compare ourselves to a couple of years ago, it's a lot more expensive to build a house or a multifamily building than it was. How's that impacting things like new housing starts and the supply in the market that you mentioned before is not so great?
So it's hard to tell because housing starts are not something that you can press a pause button on once you've started. So everybody's aware of the mismatch between supply and demand in the United States and housing. So you were correct. Going into 2008, the number that was being bandied about in terms of surplus housing units was somewhere between 1.2 million and 1.6 million. Today, the 10-year gap that they're saying is something like 5.5 to 6 million. Again, depending which number you meet, which report. So there's a whole lot of housing starts out there. The problem is it's taking a much longer time to deliver, and one cycle is bleeding into another cycle. As people start, they have an 18-month or 2-year window to build the stuff, and then other people are starting to build. So it's hard to tell when that's going to crest. But as it gets pushed out further and further, that creates a crunch right now. So while there's for sure, again, certain markets that have a little bit of oversupply, I wouldn't say that there is oversupply generally in the United States. In fact, there's a lack of housing in the United States.
Are you starting to see any sort of distress? People who over-levered, builders who extended themselves, buyers who extended themselves? Is there any of that happening yet, or is it all too early?
It's a little too early in the real estate market because to the extent that you're seeing transactions that are occurring today, that was baked in 3 months ago. So the volatility that occurred in, say, August and September is less relevant for seeing where clearing prices are. What we are going to see, and what we do see now, if you speak to any of the big brokers or even the scuttlebutt that's occurring all around, is that it's crickets out there. Just nobody's trading unless they have to.
I like the expression crickets out there. Okay. That's not the cricket we play in Australia.
Exactly. And I would say that to the extent that you're seeing deals, it's less about distress and more about pressure. So we're under contract on a deal for a debt maturity deal where a buyer has to execute at a certain point in time because their loan is due. It's less about distress and more about pressure. That's what's happening now.
Okay. All right. So you as a firm are not only active buyers of real estate as purchasers, you're very active lenders into the real estate market and have been for many years. Are you seeing now, you started to talk about before about how it's getting, rates of interest on loans are going up. Is it becoming increasingly difficult for buyers to get loans? And are we seeing that all across, or is that also sector by sector?
So I'm going to answer your second question first and go in that direction. For sure, it is more difficult in certain sectors. So the commercial market now, I don't want to say it's shut, but that's extremely hard. Multifamily, there's still opportunities, but the lending volume is down. So Wells Fargo, Bank of America are on pause, whatever that means.
Right.
And that pause can either be September, October, or end of the year, which is creating a vacuum in the market today. That said, to the extent that we're seeing loans in our business and we're trying to be active, we're seeing better loans at better rates, at better LTVs. So think back last year, we were lending up to, let's say, a whole mortgage, first mortgage at 75% loan to value. And we were earning, 250 to 300. Today, we're down at 65 and lending at 350 to 450, depending on
350 to 450 over what used to be LIBOR.
So it's like a 6% rate to put the numbers around that.
Right,
Six,
as opposed to effectively, which is really double because 250 over 3 over LIBOR was 250 over 3.
Right, 250 over was really 250 over nothing.
Yeah, exactly. So effectively, you're actually able to, you've doubled the rate of interest that you're able to charge, and you're lending a lower proportion of the overall price, and you're doing so on somewhat reduced pricing.
Exactly. So we feel good about that window of opportunity in the market. The other knock-on effect is that to the extent that you have a GP that is short of equity, you can lend preferred equity or mezzanine at a lower LTV at a higher rate as well. It's for sure costing the GP more, but as a mezz lender, as a preferred equity lender, you're much happier. That's for sure.
Right. How do you think about your exit? You're coming in very often with intermediate, a few years of lending. Are you assuming that at the other side of this, markets will have calmed down and it'll be okay, and you'll be able to get out of the loan if necessary, when time's due? Or how are you thinking about that today?
The larger the sponsor, the greater the financial resources that the sponsor have, the more optionality they have in dealing with a difficult situation. There's also relationships that you can call on in difficult situations. And that's not necessarily financial relationships, it's also equity relationships. So to the extent that there's a mechanism by which you have good partners, both on the lending side and on the equity side, we feel more comfortable. We've done an excellent job of building liquidity in our own ecosystem. Just an example, at the beginning of the year, we talked about this, and we talked about this in June when we met. We put over $2 billion of multifamily properties on the market, and we executed on 1.97 of that.
What happened to the other 30 million?
Yeah, we're still working on that. We're still working on that. And we still have a couple of irons in the fire. But the idea being is that anything that we felt that there was exposure to a more difficult market,
get rid of.
We were sellers of risk at that time.
Yeah.
And we had bought well, so we felt comfortable that we had margin there. Looking forward, we continue to feel that liquidity is very important. The thing that I'm most worried about is less about the broader market and how we come out, but the freeze-ups that you can possibly have now in the broad capital markets. So we're seeing pockets of weakness in various places that are occurring on a more frequent basis.
Give me an example of a pocket of weakness.
I just did in terms of the financing that you talked about, the idea that Wells Fargo is pulling back from CRE lending. That what is a bank supposed to do if not take deposits and
lend money out,
mortgages? But the idea being is that Jamie Dimon has been talking about this a long time, that because of Basel III requirements, banks are limited in their ability to step into periods of illiquidity and trade for their own account. And that's a weakness in the system.
Nobody's been able to replace that, really, other than private lenders like yourselves.
Exactly. Or the Fed has to come in, which is what they famously did, both in 2008, that they had the playbook ready in COVID to step in and open up the discount window. So that, I think, is the biggest problem. The financial market, the capital market, broadly speaking, freezing up. We had a freezing up in the warehouse line back in May. Several of the money center banks and investment banks had a freeze up on the warehouse lines. That caused quite a few.
And for those who don't know, warehouse lines are like overnight financing that buyers use in order to sort of, while they're getting their permanent financing organized, they'll use the warehouse line. Or maybe less wise buyers use them as permanent financing, but that's not a good idea.
So those types of things cause knock-on effects in the market, right? Somebody gets their warehouse line pulled, their overnight financing pulled, they have to sell something. Somebody has to buy it. Things start an avalanche.
Okay. So given that, what sort of opportunities are you guys focusing on, this part of the cycle for the rest of 2022 and then into 2023?
It's hard to have a crystal ball into 2023.
So let's talk about next week then.
Yeah. Exactly. A lot of it will depend on how the next few months set us up for that opportunity. Remember, for us, where we're trying to make money on a spread, the absolute rate of interest for a particular investment is not as important, relatively speaking, as what the spread is or the yield that we're earning on the asset that we're buying. And we're trying to capture the spread. The interest rates, to the extent that they're indicative of either strength or weakness in the economy, as the case may be, That's the more troubling phenomenon. The one thing that's unusual about the big R word, the recession that we either are in or going into, whether you want to use the word or not, is that household balance sheets are stronger than we've ever seen historically going into a recession. That's number one. And the job market is tighter
crazy.
than it's.
Yeah. I was looking at a statistic that the BLS published that there are 2 jobs for every unemployed American.
Yeah.
Which is it's unprecedented.
Unprecedented. So it's an unusual way, if we are going to a recession, whatever you want to call it, slow down, to be going into it. And so far, what we're not seeing, let's say on multifamily, is an enormous amount of delinquencies, which you'd expect on the cusp of a major slowdown. So people are still collecting the rents. They may, as sponsors, cease making distributions to their investors just to get over the hump into 2023.
Yeah, build up a reserve, make sure that they're going to be okay.
Exactly. So we're not seeing a lot of things shake loose. The only time we're seeing things is like this one deal that we're doing now, where there's a debt maturity, there's an actual situation where there's a pressure point that has no outlet. But those are few and far between. On the debt side, we continue to be active. There are opportunities both on the secondary market and also in the primary market, where we're lending and where we're also buying loans from other people that for pressure reasons they have to sell.
Okay, so I want to open a sort of big macro question, and you'll tell me whether or not you have any insight here. Last time we went through a big downdraft in 2008, real estate was at the center of it. And what that caused was a whole lot of unintended consequences, as I like to call the underlying plumbing of the financial system started to creak, and then the house started to flood, and in came in the fire engines to bail everybody out. And that happens when you put a lot of pressure on the system, right? And to a certain extent, that's what's happening now. Rates are going up, are spiking up. That's putting a lot of pressure on the system. We saw some real creaking in the United Kingdom last week when pension funds were on the brink of insolvency, and they had to be bailed out overnight by the Bank of England. Can you see from your mantle, from your perspective, the possibility, areas of danger where once again we could see the underlying plumbing of the financial system really come under threat?
So I don't have a lot of insight. I can tell you this, you used the right word, plumbing. And I'll give you just a very broad example to make the point even more starkly. Before going into COVID, say the US Treasury market was, I don't know, somebody can probably pick the right number, but let's say $24 billion. Today it's in the 30s. But the architecture, the plumbing of the system was only built for a $20 trillion, did I say billion? I meant trillion. $1 trillion system. And now it's 50% more. If there's a seize up in the market, there's nowhere, so to speak, for the sewage to go. It's just going to back up. And you're quite right. If it's all trying to go down one drain and there's a blockage there, there's going to be enormous effects. I'm most worried, and this is what we're doing in Harbor Group, we're focused on liquidity. Because to the extent that there is liquidity in the system, we have play in the joints, then we can live for another day and another day. What happened in the financial crisis was that there was no counterparty. There's no trade to be made. And until liquidity returned to the system, that was a very scary time. So I think, and I see the knock-on effects, again, because the banks are not built now to intermediate the financial system.
To grease the wheels.
To grease the wheels, that's what I was about to say. Exactly, right. Spot on.
Yeah, so that creates a problem. Okay, and last question, are you preparing for a rise in default on your debt book? Is that something that you can see and you're trying to prepare for? So
we're preparing for everything. We're monitoring everything. We spend an enormous amount of time, both on the due diligence front and on the asset management front, whether it's on debt asset management or equity asset management. So we're having people go out to the properties. We're tracking everything that's going on at the properties, whether it's a loan or whether it's an equity deal. I don't know that we're preparing for defaults per se, in the sense of defaults, but we're preparing for difficult times. We're making sure to escrow for caps. 2 years ago, whoever escrowed for a cap, where were interest rates going?
Right.
Today, that person 2 years hence is going to have a bill to pay. How big that bill is, we don't know. But so we know every square inch of the documents, and we're enforcing the documents.
Okay.
The one benefit that's occurred is that people are wiser about the risks of the financial market. And what we're seeing, let's say, in our CRE CLOs, our collateralized loan obligations, where we have pools of loans, many people are refinancing out, even at higher rates, because they're scared of what will be tomorrow.
They're locking it in before it's too late.
Yeah, so this is an interesting statistic. Nearly 1/3 of our book, of our old book, not our new book, but our old book, has already refinanced out or sold out.
So what you're saying is, even in a rising rate environment, people are saying, yeah, it may get worse. I've got a mortgage coming up in, I don't know, 3 years' time. I'm going to do it now so I buy myself another 10 years.
Absolutely. Absolutely.
Right. Okay.
Absolutely.
All right. Fantastic. So that was hugely insightful and interesting. We are at the beginning of the Jewish New Year. So I'm going to wish you, despite a little bit of gloom and doom in this podcast, a sweet new year and a successful and healthy one.
It should be a successful new year as well.
That's right. A lot of good health and happiness. And to all of you out there, thank you very much for listening and watching. There'll be lots of really interesting podcasts hopefully coming your way soon. And wish you all, again, a happy and healthy and sweet Jewish New Year. Saul Lubetski, thank you very much. And thanks, everybody. Bye-bye.